Joining us right now is the IPO analyst whose firm has a strong track record of predicting the performance of IPOs based on a proprietary model. Rett Wallace is the CEO and co-founder at Triton Research. And Rett, you have rated so many of the IPOs that we've watched come out this year. You're here right now to reveal your score on WeWork. What is it, and how'd you come up with it?
I wish I could say it was a good score, but unsurprisingly, it's not so terrific. It's if Uber was an average score in the scoring system, this one is below Uber but above Lyft. So in the quintile analysis, it's a fourth quintile, which actually is surprisingly good given all the bearish behavior and all the bearish talk that
I was actually going to say, I think at one point you called this a masterpiece of obfuscation when you looked at the prospectus.
They've taken
I'm surprised your score is this high, and I wonder if you included all the risk factors when I looked through your
So this is why we do it. This is where the system came from. It's very easy to sort of pick your one or two things that you want to focus on and obsess about them to the exclusion of everything else. We've all seen the reports that say, like, initiating with a buy on big market and great management team or something. So our attempt to balance out all of the different things here, forces us to look at some of the things about WeWork that aren't so terrible, right? Like, they've got really fancy investors. The growth is terrific, right? It's a really great growth story. So profitability, not so good. Complexity, not so good. Obfuscation, through the roof. These are all bad signs. So it balances to a below average, but not absolutely the bottom.
Let me ask you, though, did you get all the risk factors in? Because when I looked through the risk factors that were listed here, you did mention there were things like they bought buildings, the owner bought buildings and then leased them back to the company, which sounds at the very best like self-dealing, or at least gives the appearance of impropriety, we should say. You didn't mention, though, that he's cashed out over $700 million ahead of the IPO, and I didn't see it mentioned in there that he gave interviews to Axios and Business Insider, and that could violate the SEC quiet period.
I mean, in a perfect world, you wouldn't have to read these risk factors, right? But the risk factors are actually pretty rich here as far as things like that are concerned. And this is, again, why we try to balance all this stuff out. So the founder power is very high here. And that could be good or that could be bad in the sense that you have absolute control from a voting perspective of a founder who has taken, hundreds of millions of dollars off the table, has a complex relationship with his company, to say the least, as far as the sale of the trademarks and so forth. So there are a lot of things to not like. But it's, the problem with this story is it's not all bad, right? There are things that you can actually like as an investor, too. And there's a reason this company has been so successful in raising money. I think one of the things that's also interesting is, in the growth versus profitability conversation, there is a public comp out there that is not dissimilar in terms of the size of the footprint from WeWork. And it trades at, less than a quarter of the price talk. It's profitable, but it doesn't grow, right? So what that seems to indicate is investors are weighting very heavily the growth and discounting the lack of profitability. From our perspective, as far as this is concerned, if this IPO raises $3.5 billion and the company loses $2 billion a year, and that scales with revenue, then they are out of gas very, very shortly.
I was going to say, even setting aside all the governance issues and a lot of the noise around it, some of the criticism has been about the fundamental business of taking very long lease obligations and renting them out on a short-term basis, and how that's going to weather a downturn in the market.
So what's really interesting about the obfuscation and the lack of transparency in the document is you can't even really tell what the unit economics are of this thing in a good market, right, with occupancy rates that are really high. Total terra incognita as far as what occupancy will do and what the unit economics will do in a less good market. Can you continue to grow, keep these places full, even when we're not really sure what it costs to build them in the first place and fill them, and how long the payback.
When you talk about growth, what are you talking about? I mean, if they're losing $2 billion a year, you're not talking about profits.
No. Well, I mean, interestingly, for every dollar they make in revenue, or time over time, period over period, they spend almost $2. So you have like linear relationship between revenue growth and loss profile. And so that obviously
reminds me of an Uber or a Lyft.
It's very similar.
But when you look at an Uber and then you knew Lyft was going to be competition, is there some other competition other than the company you mentioned as a comp?
So this is another thing. I'm so glad you said that, right? Because these guys, unlike Lyft, which is a distant number two and can't really control pricing in its market, these guys are the first and really only of their type in this category. Now, pricing is sort of dictated to them in a way by the market, but at least they don't have predatory discounting that they're up against, making their unit economics even worse than they already are, because it's totally not clear that they're actually getting paid back for all the sales and marketing and development expense that they incurred just to get these places up and running in the first place.
When you say 5.82 is a score, okay, we compare it to Uber. It's a little lower than Uber, a little higher than Lyft. Where does that match up with maybe IPOs that have done very well over a period of time? Like, what does this indicate for what you think it's going to do short-term and long-term? Sure.
So the way that over time the scores have indicated the price performance, we've seen high scores do really well, like a CrowdStrike, like a Zoom, like a Zscaler. We've seen low scores that can occasionally trade where they shouldn't trade, like a Jumia, for example, if people remember that one in the last year, that's now corrected to where it sort of belonged based on its low score. And so, Uber, I think, with an average score is still a little bit out of whack, but in general, a fourth quintile score like this one, is set to return the IPO pop that people expect, although the laws of physics break down when deals are as big as this one is and as complicated as this one is. And then, the returns will be so-so to negative, right? That's what you can expect out of a company with a score like this, in general, looking at 5 years of data over time.
How does investor sentiment kind of play a role here, do you think? Because it's hard to remember an IPO that was coming down the pike where you've seen so many negative headlines, so much concern from the investor community just about whether the way it's structured, the conflicts of interest, the business model itself, the concerns surrounding, maybe a potentially risk-off environment in the market where people aren't as attracted to growth as it used to be. Right. Do you think that's a concern at all for
Well, the reason that we score for obfuscation and for sort of clarity into the metrics is because sentiment is obviously a very big driver of these things. But when investors can have sort of mathematically driven conviction about a name, when the price comes off, that might be a buying opportunity. Right? So what we saw with Lyft and to a lesser extent Uber, when you can't have mathematical conviction in the unit economics, when you don't really know what the underlying truth of the profitability story is, then sentiment is really all you have to go on unless you have access to information that the rest of us don't. And unfortunately, I think these guys at WeWork have set themselves up to trade just that way, where it's going to be very difficult for people to establish some certainty that, wow, it's a screaming buy at this price if it comes off and I want to back up the truck and buy stock. And so usually what that means is when it starts to go down, when you start to get on the wrong side of these things, the best thing to do is get out of the way.
Because it's an avalanche.
Right. And like Lyft at $51, having sold stock to IPO investors at 72 is a pretty good example of this.